Welcome back, Rick. So good to see you. How is your summer going?
Been crazy busy and doing quite a bit of traveling. A surprising number of conferences and events around the country for this time of year, but can't complain. How about yours?
Yeah, the same here. I was off the road for about 6 weeks. I'm back on the road next week. We've got a residential conference as well as a private lending conference as well. So summer seems to be slipping away when it comes to industry events, unfortunately.
Well, the bad news is that the pumpkin spice goods are already on the shelves in the grocery stores, so fall can't be far away.
For sure, for sure. So I want to get right into the RCN Investor Sentiment Survey, which, Rick, it's been a tremendous amount of effort that's gone into this, and the results have just been fantastic. The data, the proprietary data that the team has been able to put together, it's just so exciting. Finally, some real data for the industry from RCN Capital. Maybe you could share with us kind of the thesis behind it and what you took away.
Yeah, well, Jeff, credit to you and your team at RCN for having the vision to execute something like this. There are a lot of surveys out there that kind of take the pulse of different parts of the market, but to my knowledge, nobody's ever done something like that for real estate investors to find out what they're really thinking, what they believe the trends look like in the marketplace, where they're investing, what kind of investments they're making, and what kind of momentum we might be able to expect based on their current frame of mind. And so it was great working with your team to put that survey out into the field. Find out if investors thought the market was better or worse than it had been, which way they thought it was going, what their challenges were, what kind of investing they're doing, and we're going to keep doing this on a quarterly basis because it'll become sort of an index, similar to what the new home builders put out on a regular basis, to kind of let people know where that part of the market is heading. So, interesting results on this first one. The sentiment of investors right now is sort of a mixed bag. Investors being who they are, they're a little bit more optimistic about the future than they are about the current status. But overwhelmingly, they thought the current environment for real estate investing was a bit more challenging today than it was a year ago. And for a lot of good reasons that we've talked about, and I'm sure we'll talk about some more today. But their outlook for 6 months from now is a little sunnier, and they believe conditions will improve as we get through this rough patch.
So, in looking at the survey, what are the top takeaways that you came away with? Some that you may have expected and some that may have been a surprise.
One that wasn't a huge surprise but it was a surprise in the degree, was the split between fix and flip investors and investors who are buying and holding properties for rental. I believe if we'd taken this survey a year ago, we probably would have had more people saying that they were fix and flip investors and fewer people saying they were buying rental properties. But in this case, there were about twice as many folks who identified themselves as rental property investors as there were, fix and flip investors. And that kind of goes hand in hand with some other industry data that I've seen, Jeff. If you look at Adam Data's quarterly report on flipping, the number of flips in the first quarter this year was about 70,000 flips. That's the lowest number in over 2 years, and it's the fourth consecutive quarter where there have been fewer flips than the quarter before. So it's been a much more difficult market for flippers as financing costs have gone up, as home prices have sort of flattened, and as affordability has become a challenge for home buyers. But the degree to which there was a kind of flip, if you will, in those investment patterns was something that was kind of interesting to me. And if you parse that data a little bit further, this was a little bit of a surprise. The outlook that the fix and flip investors have for future opportunities was actually much more positive than the outlook that the rental property investors have. So more people doing the rental investing today, but a little gloomier outlook on the future. Fewer people doing flips, but more optimistic about things to come. So that was kind of an interesting dichotomy in the data.
Was there any data that we were able to derive that really took you by surprise and said, wow, I didn't think that was something that we were going to see?
Little bits and bites, Jeff, that were kind of surprising. Here's something that wasn't surprising, but it'll lead into the surprising part. The biggest challenges that investors identified preventing them from being successful today: a higher cost of financing, limited inventory, and competition from either institutional investors or even consumer home buyers for that limited inventory. One of the other challenges they mentioned was difficulty getting a loan. And again, if you dig below the surface level of the data, one of the groups that said they were having the biggest problems getting a loan were investors who buy multiple properties. So we're talking about larger investors, people who buy more than 11 properties a year. And they seem to be having more of a hard time getting loans than your mom and pop investor, who's probably buying and selling one property at a time. So I found that kind of interesting, and I wondered if it's because those particular investors very often work with community and regional banks to do some of their financing. And if we've seen credit tighten at those banks since we've had failures from Silicon Valley and Signature Bank and First Republic. And maybe that's why they're having trouble getting those loans. But again, it's one of those things where you need to know who your lending partner is going to be, and that they're going to have your back during these more difficult times. But I found that kind of an interesting data bit.
Yeah, that is interesting. As capital certainly has become constrained in the investment space, mostly really for two reasons. One is the price, that they're simply getting priced out of the market, where
Yep.
the capital is becoming too expensive to justify the profitability on the buy, fix, and sell. The second is the leverage that they're trying to obtain, especially on the rental loans. As that leverage has become constrained, unfortunately the rentals aren't always penciling out the way they have in the past, and that certainly came across in the survey.
Yeah, and it is a challenge right now. Again, overwhelmingly, the number one challenge the investors cited was high cost of financing. And by the way, that was true in today's market, their view of things going on today, and it was also their perspective of what's going to continue to be one of the biggest challenges going forward. And candidly, until the financial markets settle down a little bit, they're going to have the same problem that consumers have trying to buy a house, and that it's not affordable because of that high cost of financing. I guess where investors might have an opportunity going forward, if you're an investor profitable in a portfolio of rental properties, you might be able to add one or two that maybe aren't penciling out as much as you'd like today, but you can kind of offset that with some of the profits on your other properties, taking a longer view of what's going to happen with your total portfolio. But it really is a challenge for investors today, whether they're buying rental properties or trying to flip.
It's interesting. Where we're seeing success, especially on the portfolio side, is more seasoned investors who have portfolios that maybe they had a 5-arm and it's up and they have no choice but to refinance.
Right.
However, their deals are penciling out because the tremendous amount of equity that has been generated over the last 5 years. And while they may have only put 15-20% down 5 years ago, the amount of equity that has been garnered in these properties is tremendous, and the deals are working, and they're working so well because they're actually under 50% loan to value in many cases.
Yeah, that's a great point. I do know investors are challenged by the kind of, let's call them revised loan to value ratios that are being expected by lenders today. But the equity point is really a very important one. We're sitting on about $28 trillion of equity across the country collectively. And that's certainly helping people who are trying to refinance property loans. It's also helping to prevent foreclosures. One of the other interesting statistics I've seen recently is that about 92% of borrowers in foreclosure actually have positive equity, and 88% of those borrowers in foreclosure have more than 20% equity. So what we're seeing is a lot of people who get themselves into financial trouble. There's a job loss, a divorce, some other financial catastrophe that hits a household. They're able to sell their property and protect that equity rather than lose everything to a foreclosure sale. And according to some data from auction.com, about 64% of distressed property sales are taking place in that pre-foreclosure phase, so before they ever get to the auction. So for investors who are looking to buy those kinds of properties, those distressed properties, foreclosure assets, they really need to move upstream and start working directly with that distressed homeowner rather than wait for the foreclosure auction, and certainly rather than waiting for the lenders to repossess those properties, because REO activity, the repossession activity, is running at about 30% of the level it was prior to the pandemic. So very, very few assets actually going back to the banks.
So since we've gone down the road of foreclosures, let's talk about it, right? From an investor sentiment, they're always waiting for the next great deal, right? And typically that is some sort of foreclosure, short sale. You know, you and I have talked about it over the past really 6 to 9 months, that wave of foreclosures just isn't happening. We're in the dog days of summer now. Share with our investors, what are we seeing when it comes to the foreclosure rate across the U.S.?
Yeah, great question. In a normal market, about 1 to 1.5% of all loans are in foreclosure. In today's market, according to the Mortgage Bankers Association, it's just over 0.5%. So we're well off normal levels, and we're only running at about 60% of pre-pandemic levels if you go back to 2019. So overall foreclosure activity very low, and that goes back to the strength of the U.S. economy right now. We have unemployment rates sitting at about 3.5%. We have 9.6 million available jobs and about 6 million people looking for work. So the economy, the strength of the economy, the strength of the jobs market is directly correlated to what we're seeing in terms of foreclosures. In fact, there's a really strong correlation between unemployment rates and mortgage delinquency rates. And at the end of the first quarter, we saw unemployment rates at about 3.5% and delinquency rates at 3.56%. So can't get much closer than that. And those delinquency rates are lower than historic averages. Normally 4 to 5% of loans are delinquent. And that's keeping the number of foreclosures very, very low. We're running at about 80% of foreclosure starts prior to the pandemic. So that initial notice of foreclosure, the number of people getting that notice is actually catching up a little bit more quickly to what we've seen in past cycles. But then if you go to the next stage of foreclosure, the properties being auctioned off, that's running at about 50% of pre-pandemic levels. And as I mentioned, the number of repossessions done by the lenders is running at about 30%. So something's happening between that first foreclosure notice and the rest of the process. And increasingly, it appears that those distressed homeowners are finding a way to sell off the properties prior to the auction, and certainly prior to when a bank would repossess it. So if you're an investor in today's market looking for a deal on a property, you really don't want to wait for the bank to repossess the property, because that's just not happening and not likely to happen anytime soon. You can go to the foreclosure auction, and properties are selling at a pretty high sell-through rate at those auctions right now. But again, it looks like the majority of the property, almost 2/3 of the properties in foreclosure, are selling prior to the foreclosure auction. So you really need to be doing your homework, finding those borrowers in the early stage of foreclosure, reaching out to them and negotiating a deal. And if you're a buy and hold investor, a lot of these folks maybe got behind on their mortgage payments and can't make up the past due amounts and the fees and the fines, but they probably could be a good rental tenant. So you could negotiate a deal where you buy the property from them and rent it back to them because they want to stay where they are. So a lot of ways to be creative in today's market that maybe weren't the case in previous cycles.
It's interesting. The tried and true method that investors have always had is waiting for the foreclosure court step auctions, et cetera, et cetera. And it sounds like today the key for investors is you need to get in the middle of the process before the actual execution takes place. Are there any tips or tricks that investors should think about in order to be able to do that?
Well, there are services that you can sign up with that will actually provide you contact information of borrowers in foreclosure. So you might want to look at things like that. There's websites like Foreclosure Radar, foreclosure.com, Realty Track. These are all paid subscription services. If you have a friend in the title industry, very often the title agents can find lists for you of buyers in a local market that are in distress. There are real estate agents in many markets who specialize in that part of the business and can get opportunities in front of an investor. So there are ways to do that, and you could also do cold calling. Just canvass an area and let people know that if they're in the market to sell a property, you have funds available to buy today. So a lot of ways to do that. Again, I know a lot of investors will invest in these paid services to be able to get timely lists of borrowers in foreclosure. And then, of course, it's a question of how you do that outreach in order to connect with that borrower who typically is kind of in an emotionally messy place, and help them walk through their options. I really believe that a lot of borrowers in foreclosure don't actually know that they have other options. They get that foreclosure notice and they think it's a fait accompli and they're done. And you can actually help them avoid that losing proposition where they're going to lose everything at the foreclosure sale by negotiating a deal that gets you a property below full market value, but allows them to salvage most of their equity and get a fresh start.
Well said. Well said. So let's transition to rates. It certainly is a topic as a lender that we spend all day talking about. Where are rates going? What do we expect? When is the Federal Reserve going to take their foot off the brake? It goes on and on and on. Let's really get in the weeds on this, Rick. Here we are once again, August, trying to see the light at the end of the tunnel when it comes to mortgage rates, especially on the Fannie Freddie side, being all over, mid to high sixes, sometimes 7. When are we going to start to see some relief here?
Well, mortgage rates have been trading in a fairly narrow band between about 6.5% and 7.1% for the last month or so. And I expect we'll see that for the remainder of August and probably into September. The Fed has signaled that they're going to consider stepping back at this point, and there might be one more increase in the Fed funds rate this year. But what's been interesting over the last couple of weeks is we've seen a number of the governors, the Board of Governors, come out and say maybe this has been enough. Maybe we should take a step back and just see what's going on. And we've seen inflation numbers come down pretty consistently. The last report, inflation was down to 3% year over year, which is very, very close to the Fed's 2% target, and well below that 9% we saw just a number of months ago. So I have a hard time putting my crystal ball in place because the period of time has lagged a little longer than I expected already. But I do believe, particularly once we get past the Fed's September meeting, and if they don't do anything unexpected, we will see rates come down for the balance of the year, slowly, but steadily, and could be in the low sixes or maybe even below 6 by the end of the year, depending on whether or not the Fed has another rate hike up its sleeve. we need to do that just to get affordability back in the marketplace. And we're probably going to have to get down into the mid to low fives before we start to see home sellers come back into the market. We have no shortage of buyers, and every time the rates come down a little bit, we see more buyers coming to the market. But the rate lock effect that economists talk about is very real. If you're a homeowner sitting on a 3% mortgage, you really have no incentive to put your property on the market, sell it, and buy another property with a 7% mortgage. I mean, think about that. If you bought a property that cost exactly the same amount as the one you're selling, your mortgage payment would double. So it really isn't much of an incentive for any of those current homeowners to get into the market. But the hope is that once the Fed says we're done, the markets will settle down, the risk and volatility will come out of the market, and we'll see the rates get back to a more normal level. And by that, I'm talking about the spread between the 10-year US Treasury yield and the 30-year fixed rate mortgage, which tend to have a very strong correlation. So usually a 30-year mortgage rate is 1.5 to 2 points higher than the yield on a 10-year US Treasury. So if the yield is 4 on the Treasury, your mortgage rate would be 5.5 or maybe 6%. Today, there's a full 3 points in between those two things. In fact, a little bit more than 3 points. So if we just got back down to a more normal spread between the Treasury yields and the 30-year fixed rate loan, we could see a full point come off mortgage rates, which would make a huge difference for the market.
So I'd love to dive into that a little bit. And I know some of the experts in the mortgage field have discussed the thought that the spread is so wide because of the servicing component, right? Because, everybody knows the rates are coming down eventually, and the servicing rights just aren't going to be there to be able to justify that. So for the audience, why is that spread so high? Can we nail it down to one or two things that we should watch for to think about how it narrows, or is it more of a basket?
I think, unfortunately, the reasons for the spread between Treasury yields and the mortgage rates being as high as they are today is something of a basket. And I've seen people online kind of pontificate that it's this factor or it's that factor, and the truth is it's probably a combination of factors. You raise the notion of servicing and the value of mortgage servicing rights. And it's interesting that in today's market, most of the consumer lenders who are profitable are lenders who have servicing portfolios. It's tougher for the lenders who are relying strictly on loans to make money on those loans because their overhead costs are so high compared to the volume of loans being issued. So the ones with servicing portfolios are actually being more profitable today. But the future value of those servicing rights is in question because, as you know, if rates come down significantly, there's likely to be a wave of refinances, which means people will be prepaying their loans, which reduces the servicing volume for the lender, and it just kind of throws things into a little bit of chaos in terms of forecasting. There are other things that are a little bit even less tangible, and I talk about risk and volatility. The industry really isn't sure what the Federal Reserve is going to do and what the cost of capital is going to be, and I think because of that, they pretty much build in a cushion when it comes to loan rates today. Historically, that's happened when the Fed has gone into its rate hike cycles, and then the good news for borrowers and really for lenders at the end of the day is that when the Fed has announced that it's done with its rate hike cycle, mortgage rates have always come down. So and that's happened literally every time in history that we've gone through these cycles. So I think the risk and volatility index, if you will shrink as the Fed announces its plans to take a step back, and we'll get closer to those normal spreads.
So that's a great point you brought up, which is especially folks that aren't really aligned with how the mortgage versus Treasury and how it all works and how we have seen patterns in the past. But you mentioned that when the Fed announces, or you read the tea leaves that come out of the Fed notes that they're done, right? In the past, that will immediately have a reaction on the 30-year debt, the Fannie, the Freddie debt, long before we even think about the Fed going the other direction. So
Right.
maybe share with the audience kind of what the history's been on rates moving the other direction long before the Fed begins to reverse their actions.
Yeah, there is a kind of a popular meme out there that the Fed will pivot and they'll start reducing the Fed funds rate, and that's when market conditions for lending will improve. And the Fed has signaled, particularly in this cycle, that's simply not going to be the case, that they are anticipating that they're going to have to keep Fed funds rates fairly high for longer than they usually do in order to make sure we don't have a rebound of inflation. The good news for the industry is that, historically speaking, that shouldn't matter when it comes to mortgage rates. Once the financial markets are relatively certain that the Fed's not going to continue hiking short-term rates, the risk factors that apply there can be removed, and we will start to see rates come down. In fact, when the Fed paused this summer and didn't hike rates at one of its meetings, we saw rates start to come down a little bit by themselves. Now, it wasn't by more than a few tenths of a point, but that happened almost instantaneously. So I think once the market can kind of factor in what the cost of capital is going to be based on Fed activity and project that out, you start to see a normalization of things like yield spreads, and we will see mortgage rates come down. The wild card here is candidly the bonds market. This is something you and I haven't talked about before, but we've seen the yield on the 10-year U.S. Treasury get to almost the highest point it's been in the last couple decades, and not sure exactly what's causing that rate to go up. But again, if the mortgage rates are based loosely on the 10-year yields, that's something to keep an eye on too. If those yields go up unexpectedly, that could have an impact on mortgage rates and slow down the decline in those mortgage rates.
So, I've been reading a lot about supply and demand, and the amount of paper that the Treasury Department is being asked by the legislatures, right? Like, they're the ones who approve the spending, and the Treasury Department has to figure out how to pay for this spending that has already been approved. And if we don't have the money coming in the cash register in the receipts, then we got to go borrow it. And I have been hearing, especially over the past few weeks, that the amount of debt that needs to be raised between now and September is massive. And I'm wondering how that's playing into the supply and demand equation of just how much appetite for our debt and what the cause and effect will be on rates. Because if the demand is less, the only ways to raise demand is to raise the rate, right, and the market will take care of that.
Yeah, so you raise a good point, Jeff. The government's become notorious for deficit spending, the federal government, and you need to pay those bills somehow, and very often that's by going out and raising debt, and that does have an impact on bond yields. So if in fact there's I guess, to use mortgage industry terms, a balloon payment coming due in September, then that could have a direct impact on the bond market and the yields on those bonds getting richer in order to entice people to take on that debt. So something we'll have to keep an eye on, kind of probably above both of our pay grades, but the bond markets will definitely have an impact on mortgage rates. And until we start to see those mortgage rates come down, affordability remains a challenge. Inventory remains critically low, and it's just going to be a tough time, not only for consumer home buyers, but for real estate investors as well.
Interesting. So let's pivot here and get into the supply and demand equation. Let's talk about home sales. Let's talk about how many houses are on the market today existing? And then once we kind of digest what's happening from the existing standpoint, I'd love to talk a little bit about new construction. But let's get into
Yep.
existing today, where we are, less, more, what's happening out there?
We're running at about a 2 month to 2.5 month supply of homes available for sale. So that's if how long it would take to exhaust the inventory of homes at today's rate of selling. In a normal balanced market, we would have about a six month supply. So we're running at about a third of the normal level. And if you look at inventory compared to the last, let's say, normal year in the market, which might have been 2019, the amount of inventory we have is about half of where we were back then. So just not really good news on the inventory front for existing home sales, and really not a particularly optimistic outlook that those numbers will improve. We've talked a little bit about the rate lock effect. 80% of borrowers have 93% of borrowers have a mortgage rate below 6%. About 70% of borrowers have a mortgage rate below 4%. Those folks just have no incentive to list their property on the market. And in fact, typically have a huge financial disincentive because they'd be trading in a 3.5% mortgage rate for a 7% mortgage rate, and their monthly costs would skyrocket. So until we see mortgage rates come down significantly, and most of the economists I talk to think the inflection point's probably somewhere below 5.5%, we're likely not to see a lot of these properties come to market and improve inventory levels. The only reason inventory levels are as high as they are, candidly, is it's taking a little longer to sell properties once they're listed. But if you look at new listing data, new properties coming to market, they're off about 50% again on a year-over-year basis. So we're not seeing a lot of new listings coming to market. I don't expect to see a lot of current homeowners list their properties unless they need to for family reasons, financial reasons, or whatnot. But it's going to be a slow market, and I think that carries through the rest of this year into next year.
Maybe get a little granular with geography. Are there different pockets around the country that are more challenged than others from an inventory perspective? Are we starting to see inventory increase in some markets where maybe there's economic factors at play?
Yeah, the truth is, Jeff, I haven't looked at every market across the country, but every market I've looked at is pretty much in the same space, and some are even worse. I mean, there are markets on the East Coast, the Southeast in particular, where there's 1.5 month supply of homes available for sale, which is virtually nothing. So if you're looking at markets with strong job growth, strong population growth, the inventory numbers are even worse than the national ones I just gave you. If you look at some of the higher price markets, high price, high tax kind of states, you might see inventory a little bit higher because it's just taking a little bit longer to sell those more expensive properties. So coastal California, we might have some zones in there with a little bit more supply. But the state of California, for example, is right in the national average of about a 2.5 month inventory of homes for sale. So I'm not seeing markets where there's a lot more inventory, but I do see some markets where inventory is even more critically endangered.
Interesting. Thinking about our friends in the new construction business, and I can speak for us here at RCN, we've seen a material uptick in ground up financing requests and closings this calendar year. Certainly last year, we saw a shift to more folks looking for ground up financing, but this year it's noticeable and it's making a difference in our production. Let's talk about ground up construction, both on the institutional side and maybe more just mom and pop builders across the U.S.
Well, if there's nothing to buy and you want to be an investor, maybe the only option left is to build. And so we are seeing across the country an increase in permits. We're starting to see a little bit of life in housing starts. And the housing start numbers are always a little bit fuzzy. It's survey data from the Census Bureau, and it tends to reflect what's going on with the larger builders as opposed to the mom and pops. I suspect under the radar, under those national housing start numbers, we're probably seeing quite a bit more ground up construction from those mom and pop investors who used to be the ones financing the purchase and resale of existing homes. The builders themselves are still not building enough to meet that demand that we talked about when it comes to the lack of existing homes. But we are seeing new home sales actually outpace last year's numbers, which is not the case with existing home sales. In June, I believe we were off by about 18% year over year in existing home sales, but new home sales were actually up year over year. And the builders are offering concessions to get people to buy. So the median price of a new home this year is off about 15% from peak last year, whereas the median price for an existing home is only off a little bit less than 1% from peak on a year over year basis. So we know the builders are building homes with smaller footprints. They're building homes with a lower price per square foot. So they're trying to accommodate the buyers. And new home sales right now make up probably about 20 to 25% of all home sales, where in a normal market, that number is more like 10 to maybe 15%. So since there are no existing homes for sale, people are looking for new homes. And I think it's an area of opportunity for investors who know what they're doing when it comes to ground up construction. And that's a caveat I would want to probably put in all capital letters. If you can lose money buying and selling a property, you can lose even more money more quickly trying to build one from scratch if you don't know what you're doing. So it's not a panacea by any means, but it probably is a reality in today's market that we're seeing more people try and pursue those construction projects.
And, certainly over the past 18 to 24 months, we heard about all the challenges that contractors and even institutional who are direct to factory challenges we're having with materials and things you would never even think about, such as windows and even infrastructure plays. Hearing about transformers for new lines on roads that couldn't get power to houses. Where are we with sort of the supply chain when it comes to new home construction?
There are still stories here and there anecdotally about supply chain disruptions, but they are much fewer and further between than they were a year ago. Just anecdotally, here in my household, it took us about a year to replace a stovetop because the one we ordered was on back order. So I can't imagine trying to build out a new development and what are you doing with appliances and roofing materials and windows and doors and the like that we're all sitting in the port of LA somewhere, in ship number 422 that was lined up there. And in fact, you can see it in the numbers that the situation is improving, because about a year ago, we had the highest number of homes under construction in the history of the data, which goes back to the early 1970s. And we had the lowest number of completed homes available for sale. So it was clearly an indication that there was this backlog, a glut of homes that were in the middle of construction that the builders just couldn't get finished for one reason or another. In some cases, it was supply chain disruptions. In some cases, it was labor shortages. And we've seen those numbers start to normalize pretty dramatically over the last 6 months or so. So we're back to almost normal levels now of properties under construction and just a little bit below normal levels of properties available for sale that have been completed. But the builders are selling a lot of these homes while they're still in construction. So the inventory of homes that are completed isn't rising quite as quickly. Housing starts have been sluggish. They're down on a year over year basis if you look at single family home starts. But what's interesting is permits are actually going up. So the builders have an eye toward the future and are obviously bullish on opportunities down the road, but they're not willing to get out over their skis or take much of a risk in terms of actually starting those housing projects in today's market, probably because they're a little concerned about demand being weak because of affordability. So I think it's another one of those things that when we see mortgage rates start to come down, affordability start to improve, a lot of these permits will turn into starts, and it could have a material effect on available inventory.
Yeah, well said. And it's interesting. Some national publicly traded builders reporting record profits, and clearly the throughput, the kind of the wheels that move, as you mentioned, slowly, but it seems to really be finally the homes are hitting the marketplace on the institutional side.
Yeah, the people have asked about whether or not we should expect a housing crash again, because I think everybody still has PTSD from 2008. And one of the big differences this time is that the builders never got the memo in 2008. They just kept on building when people stopped buying.
Yeah.
And so we had a glut of inventory between new homes and existing homes. We had about a 13-month supply of homes available for sale right before the market crashed. And that's about twice as much as we would normally see in a healthy market. So at precisely the time when the finance markets went sideways, there were way too many homes available for sale. And it just was, one of the elements that helped create that perfect storm. When buyers slowed down last year after the mortgage rates skyrocketed, the builders really slammed on the brakes pretty quickly, and so they are kind of meeting out their supply as fast as demand will eat it up, but no faster. They're not taking a risk of having a bunch of properties sitting there vacant at the end of a development for months at a time, and they sell those before they start building the next ones. So it's a very measured response. I saw the CEO of Taylor Homes on CNBC last week, and she acknowledged that the industry had underbuilt for about 15 years, but also acknowledged they probably weren't going to fix that anytime soon because they didn't want to take on the risk of too much inventory. So it's a good time to be a builder. Huge demand for your product. Even though prices are down from peak, they're still very profitable units to sell, and demand doesn't seem to be going away anytime soon.
Smart. So I'd like to wrap up today sort of at a macro level. Investors, especially investors who have built out substantial rental portfolios, whether it be single family or multi, especially on the multi side, are always concerned about a slowdown in the economy that is going to pinch their tenants' ability to be able to afford the rent that the landlord is charging. And certainly, the smart folks were predicting a recession, that we'd already be there by now. Now the sentiment seems to be changing to soft landing. Let's try and give the audience an idea of what you're seeing on the recession front and where we're heading, if at all.
Well, let's that lot to unpack there, Jeff. Let's start with multifamily and single family. If you look at year over year asking rents, multifamily is still up a couple points, maybe 3 to 4%, depending on what market you might be in. Single family asking rents are actually down a point or two. Again, these are national numbers, so local results will vary. But it's not necessarily reflecting that people can't afford something as much as it is, I think, just kind of a resetting based on supply and demand, and maybe prices were starting to accelerate a little bit too quickly. In terms of a recession and the impact, there are still two historical data points that I look at that say a recession is still at least somewhat likely. One of those, excuse me. One of those is the Federal Reserve's very aggressive, almost unprecedented action in raising the Fed funds rate the way it did, and the risk of an overcorrection as they do this. If you go back as far as World War II, they've raised the Fed funds rate, not counting this time, 11 times previously, and only 3 of those times did they do it and avoid a recession. And all 3 of those times, they started raising the Fed funds rate to get inflation under control before inflation got too high. In this case, they've already admitted that they were late to the game, that they didn't expect inflation to get as high as it did, and they really expected it to be transitory, which It clearly was not. So my looking at that historically, you'd wonder why this particular cycle would be any different from the other 8 times that they did this and steered us into a recession. The other is the yield curve inversion. And without getting too inside baseball on people, typically your yield on a 2-year bond is lower than the yield on a 10-year bond, because the 10-year bond is a longer investment cycle and more risk and so forth and so on. Every now and then the bond market sees blood in the water and a disruption in the force, and those two things change places. So the yields on that 2-year treasury are now higher than the yield on a 10-year U.S. treasury because the bonds market senses something that's not going to go well. Every time that's happened, the last 7 times in a row that's happened, it's been followed by a recession. This has been a fairly significant yield curve inversion, and it's been one that's run on now for many months. So again, if you look at history as precedent, that's another indication that a recession might be more likely than not. Having said that, the Fed has taken really unprecedented levels of aggressive nature, raising the Fed funds rate to slow things down. And while they've done that, unemployment has stayed at 3.5%, with more job openings than there are people looking for work. And these, by the way, are not all service level jobs, despite what you might be hearing on YouTube. These are jobs in every industry segment you could imagine, except maybe the mortgage industry right now. And so there are a lot of jobs looking for people to fill those jobs. And then the gross domestic product, the GDP for the second quarter, came in at 2.4% growth, which was an increase from the first quarter. So despite everything the Fed is doing to slow the economy down, the jobs market remains incredibly strong, and overall GDP, the overall economy, continues to grow. So is there a scenario where they sidestep this recession because every other aspect of the economy is performing pretty well? Yeah, there actually is. If I were going to flip a coin today, I would say it probably still comes up on the side of a recession. But I've said all along, if we had one, it would be fairly mild and fairly short. I'll stick with that. But would I be completely surprised if they were able to kind of toe the line and avoid a recession this time, based on what we're seeing so far? Not completely. So there is hope that we avoid this entirely. But obviously this is one of those things that time will tell.
Well, with that said, we're coming up on the top of the hour. I appreciate all the insight and look forward to doing it again next month. So thank you so much, Rick.
Thank you, Jeff.